GHVI Spac is merging with Matterport. The deal is expected to close in the second quarter of 2021. What is Matterport? So Matterport is capturing the physical essence of real estate and replicating it with a digital twin. Matterport seems to have an unrivaled value proposition with a data library, a spatial data library that's second to none. Having a digital copy of a physical property has many real-world applications. For example, real estate firms can now more easily tour properties and sell properties, often for premium, so selling faster and for more, which is a win-win all around. Architecture, engineering, and construction firms can track how a building is progressing through the construction cycle with Matterport, being able to say, oh, okay, this is the layout. Is it actually matching to plans? The question is, what's the right valuation for Matterport? While the company is experiencing hyper growth, very fast growth in 2020, the stock already trades at nearly double the deal valuation, and I just don't think the risk reward at current price, nearly double the deal price, is that compelling at these levels. I'll go into full detail later on in the video. As usual, we'll share an exclusive sheet for YouTube subscribers. And this video goes out to Amira and Jan, along with all of my Unrivaled Investing Journey subscribers. About that, a quick 10-second plug, if you will, where my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, make sure to hit that subscribe button. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey as I call out potential multi-baggers each month, go to unrivaledinvesting.com, click on Journey. So let's dig in to GHVI and Matterport. So what's the deal? So here you see all in, my mug's blocking a little bit here, but all in around $600 million that's coming in that's going into Matterport from the cash and the proceeds from the PIPE. So all in a little over $600 million. It's starting off as GHVI Spac. So that's the entity that's trading now. If the deal closes successfully in the second quarter of 2021, it'll be MTTR. That's at least what it's expected to be. And so you can see the vast majority of the cash is going to Matterport's balance sheet. It should help fund their growth. I mean, they are expecting to have some material losses over the coming years, so they do need this cash. And then just to pay some very reasonable deal expenses. So this is fairly straightforward, and this is what I like to see. The cash going to the company to help, further hyper growth. So what is Matterport? So we understand sort of the basics of the deal, but what is actually Matterport? What's the company that's going to drive the value for SPAC shareholders and ultimately Matterport shareholders if the deal converts or successfully merges? So Matterport is at the forefront of digitizing physical spaces. And so they advertise, take your building online, and you can see this McMansion and how here's the gym and here's the staircase and here's maybe the loft, and you could look, and it's sort of a super... It's sort of like a 3D version of a house that you can sort of walk through and oh, this is what the room looks like. It's a very different field than just taking pictures and clicking like an arrow. It's oh man, here's this physical outlay that's proportional to what the reality is to each of the objects. You can spin it around, you can dive into it. So as they're saying, it relates to design, build, promote, and manage your most valuable asset at your fingertips. Now, why would you want a digital copy of property, whether or not it's residential or commercial properties or industrial properties? Why would you want a digital copy of your physical assets? And there's actually a lot of different reasons, and they're sort of going with the low-hanging fruit first, but over time there should be more and more applications for having a digital copy. For example, it's much easier to build something out when you can improve the quality, streamline the workflow, where you can, let's say, take a picture and do this out, get a 3D representation, let's say every week if you wanted to, see how it's going, see how it tracks relative to plans. It becomes very obvious where the choke points are, or where the bottlenecks are, or hey, this isn't actually matching to plans, or hey, this is coming along perfectly. You can see exactly where you should be in terms of the progress. Another aspect is promotion. This is particularly, whether or not you're a real estate broker or you're renting an apartment or something, where you can show off a physical property halfway around the world using a digital representation, where you get a much better feel for, oh, okay, this is how I'm walking through the apartment. Oh, I can see the whole house practically in my hands if I wanted to. You're oh, we go down these stairs and that's where the gym, and there's the library, and there's the bathroom. And so you could see this. Or let's say you're managing, a retail empire, a chain of franchises, a chain of branded stores. Well, you can see what each one looks like, and you can manage it all from one central hub without having to visit everyone and say, oh, this is laid out the way it's supposed to be, or oh, the dimensions are off a little bit. So operating, so that's increased return on investment, reduced costs. You can see, hey, is everything operating the way it should be? Is everything where it should be? Insurance, this is a key aspect where, insurance companies that want to underwrite the risk, instead of having to necessarily go to the physical place, they can say, hey, we want pictures of everything and we want this digital representation. Oh, there's cracks over here. Yeah, we're not going to insure that. Or the insurance is going to cost you a lot more if you're, we're insuring this load-bearing wall or something like that. And then repair, where they're saying a reduce time in the field, inspect remotely. They can check all this stuff out via a digital representation. So you can see repair, design, build, promote, operate, insure, and it impacts all these different industries like retail, real estate, travel, construction, corporate, industrial, commercial. So you can see how all of this can play out and how this would fit together. Like hospitality is a perfect one. Let's say you have a spa and you have a franchise spa model. Well, someone who owns, let's say, 3 different spas, they can check, oh, let's do a digital representation of how everything's laid out. Oh, the plants, they need to be over here. Oh, the sanitizer needs to be over there. Oh, you got to keep the towels and everything over there. And this one's sticking to the model perfectly. This one is not. And you can call that out, and you do that, once a week, do that once a month, and it's a good way of managing your properties, getting a good sense of, how everything's performing. And, in retail, they call it out as a potential way of training employees. If you have someone come into your store, now obviously that's a post-COVID type of development, but someone come into your store, you can train the employees. Oh yeah, let's do a digital representation. You should be able to know where everything is in the store. So that way, whoever comes in, you can direct them. Oh yeah, you want this? Oh, you want that? I know exactly where it is in the store, in this layout. A lot of potential value. Now, is this just a theoretical company, or do they actually have real customers? And so you can say, wow, this is actually a really diversified customer base with over 250,000 customers across all these different verticals that I just called out, 150 plus countries, 13% of the Fortune 1000. So you're tapping into some of the largest companies as well, and less than 10% of their revenue comes from the top 10 customers. Now that's an important point because I've actually called out a couple of SPACs now. And this is part of the reason why investors should be aware about SPACs. And I talk about why, there potentially could be a SPAC bust in the near future. Journey subscribers know about it. But this is a perfect example of the risks that a lot of people aren't necessarily aware of at first with their SPACs. Is oftentimes you do have big customer concentration risk where they don't advertise it in the presentation, and then only later on you find out, oh, 90% of the revenues from this one customer. Makes you want to rewrite your thesis. So, something to know about how upfront people are with the facts with the SPAC process versus IPO process. Either way, I call this stuff out in the SPAC potential bust video for Journey subscribers. And so you can see like all these different verticals that they have real customers. Redfin, Hyatt, Airbnb, LinkedIn, Georgia Pacific. So you can see that this covers a lot of different companies, a lot of different aspects, looking at how do we manage real estate? How do we make sure this real estate is being monetized in the correct way? So what's the opportunity here, when you're looking across these different verticals? And they're thinking, wow, this has at least 100x potential. At least that's how they're framing it, saying, look, there's 4 billion buildings in the world, 20 billion spaces within those buildings. And if you just charge $1 per space per month, so effectively charging on a per room basis, which it's an interesting way to think about it. They're saying at 1% penetration of this 20 billion spaces, that's 200 million, and that's how they get $2.4 billion annualized revenue versus 5% penetration in this at $1 per space per month gets to 12 billion. And so they're saying like, look, from from around 100 million in revenue now, there's lots and lots of upside, 100x potential over time. Now, I would be a little bit skeptical on using this just because it's like, well, wait a second, like, does this business model actually map out to $1 per space by, per month right now? And, or is that sort of, fugazi sort of thing? Or they have an even more aggressive outlook where they're saying, hey, what if it's $5 per space per month, in which case you're doing 12 billion annualized recurring revenue, or potentially 60 billion if you get 5% penetration. That sounds really great. Really, like hundreds and thousands of percent upside. Why not? So let's sort of go over where they are today. So you see they have ubiquitous capture. Historically, it was their own proprietary technology, but in the last few months of 2020, they really started rolling out both iPhone and Android. So that way you can use one of those two key OSs and use your phone to effectively capture this spatial representation of your physical property using just your phone to add to this spatial digital library. And look, they have millions of buildings and spaces, billions of square feet captured, billions of 3D data points. Because keep in mind, it's not just the buildings. You start layering in additional detail like, hey, here's everything inside the building. Here's the chairs, here's the artwork, here's the tables. And then maybe you start layering on different things like price tags and how much each of these items cost and what's their exact dimensions. So that way it's easier to lay out. Oh, okay. If you have an empty house, now you can drop these things in. Or maybe if you're an insurance company, you can automatically, like renter's insurance. Maybe if you're a renter insurance, you go, oh, okay, or homeowner's insurance, let's do a quick scan around with the camera, and using an algorithm like this, we can quickly size up. Oh, actually, the liability here is actually way higher than our normal. You have a lot of fancy chairs here. You know what? We're going to have to bump up the rates. You have a lot of fancy chairs, and I see that you have a lot of pets that are running around. Maybe your rates need to be a little bit higher. You know, you have that. You're going to create new data points that you wouldn't necessarily have before, and with more data comes better insights. So, you know, ultimately, with all this data, can they create better insights with, you know, computer vision analysis, deep spatial indexing, saying, hey, here's this lamp, and here's how much space it takes up relative to this desk. Could you fit this here? And ultimately building out a 3D software marketplace. And we'll talk about that in just a second. Search engine for buildings. So if you have a major real estate company and they have many of their all of their buildings, let's say profiled, then they can say, hey, which buildings have number of conference rooms? Oh, okay, which building in our portfolio has the largest conference room? And oh, if we're looking at our largest buildings, are there any sort of common characteristics that we see physically inside that might set them apart? There's a reason why they trade at a premium. So you're going to be able to get better analysis by having these digital representations done. So, you know, that's sort of where they are today. In the future, it's about, you know, so this is where they are today, unlocking the flywheel of getting more and more data. And then with more and more data, can you create better and better insights? Then expand internationally. They're already in 150 countries, so then it's just like, hey, let's add fuel to the fire and just grow their presence in these international countries. And then also this third-party marketplace, which is when you have lots of data, can you start layering on really cool apps that have a lot of value, like that insurance company app I just mentioned of like, hey, it's easier to underwrite or more accurate to underwrite what your potential cost would be as a homeowner. Or for an insurance company looking at a commercial building, oh yeah, look at all these fire hazards you have. Like that definitely needs to get cleaned up. You know, you can't have all that paperwork right next to the, you know, electrical outlet or something like that. There's lots of different ways to spin it, but you can see why having all this data could create a marketplace for people to say, hey, here's my app for insurance company. Here's my app for real estate agencies. Take an empty house and here's a bunch of things that you could throw into it to give people sort of inspiration. Oh man, would this item fit in here? Maybe it's helping IKEA drop these digital representations of their catalog into an empty house to be like, oh okay, that's how we do it. So it's all about the future in terms of leveraging this data that they're building now to create additional value for these different verticals, whether or not it's insurance or real estate or just creating a searchable database. Let's see all the houses that have this feature. So, you know, when you look at it, it's really impressive. They have around 100 million run rate revenue. So this company is legit. They got real revenue. It's not just pie in the sky company. You know, a lot of SPACs are like, hey, we have zero revenue now, but we're going to have billions in the future. And so I'm like, okay, I can wait for you to start proving that. Here, they're already proving it a little bit. They're saying, hey, we got 100 million run rate revenue, and really we're crushing it in terms of subscriber growth. I mean, look, we went from 14,000 to 40,000 from 2018 to 2019. Then we went from 40,000 to 250,000 subscriber growth. I mean, 18 times subscriber growth over 2 years. How many companies can point to that level of growth? 18x growth in subscribers over that time frame. Now, I would caution you, they're gonna use that sort of metric, 18 times over 2 years. But the reality is their growth rate's only 90% revenue. So a lot of this growth is actually from free users using it. But hey, having a free use model is good. It gets people inside the system. You start downloading data or uploading data, and then eventually you say, you know what, I need to pay for this product. So I have no problem with that, increasing the value of their spatial library, but one should recognize this 18x growth doesn't tie to their revenue growth. And what they're saying is they're 100x the rest of the market. They're multiples of the size of any other comparable spatial library, where they have 4.4, I think, million square feet or something, or 10 billion square feet captured here, 4.4 million spaces under management. That's what it is, 4.4 million spaces under management, 10 billion square feet captured, 150 countries and counting. So lots of growth. They are showing, hey, we have this unrivaled database. No one else has what we have. Now, how does this translate into financials? How does this translate into what they could potentially do in the years ahead? So what they're penciling out, based on 85 million in revenue. So once again, going from 46 million to 86 million in revenue. So, pretty sizable growth rate from 2019 to 2020. Still not nearly the same, 4x growth in subs in 2020. But still they're penciling out material, revenue growth. But, you look at this and, they're effectively saying, hey, we think we can nearly 10x over the next 5 years. I mean, another company saying, hey, we can 10x in just a few years, nearly 10x, going from 85 million to 750 million. I'd want to dive in a little bit in greater detail to actually understand what are the moving pieces here. So you have subscription, and that's the piece of like, hey, you upload this data and you need to look at this data going forward, or you need to have the analytics, and it's a recurring expense. And that business is growing very quickly. And they also have a licensing business, and looks like it's fairly new because it was zero in 2019, and they're saying it'll be a couple $1 million in 2020, and that's also expected to scale up more than 10x over the next few years. But then critically, they have these other components. So I would think of it as a high margin business and lower margin business that they have all in their revenue. So the high margin is subscription and license, and that's, this 80% plus gross margin. But then you also have services and product, where product is actually selling the fancy cameras that they've historically sold to capture these 3D spatial representations of physical properties. The challenge is that with them rolling out the iPhone, the Android cameras, so that way anybody can capture the 3D spatial representation, and the second half of 2020, it's given that you no longer, it sounds like, need to actually get the physical cameras that they were selling, which historically was a very good chunk of their revenue, there's a reason why it's effectively flatlining over the next few years. Now, I wonder, why is it flatlining and why isn't it declining? Now, I'm sure they have a reason, but one should understand when you're flying a jet and one of the engines is sort of out, that's sort of what's going on here with their product. Like, that's not expected to be a growth driver. Now, they do have this services segment, which is where they're paid by the company to say, hey, can you film this for us? Do this for us, create this 3D representation for us. So there's a good chance, and that is a global network of folks that they've hired, where they say, oh yeah, any property around the world, we can help you get that, create that 3D representation. We have folks that are trained to do that. So effectively, that's going to be lower margin because it's all these people versus a software type expense. But that should, I would imagine, scale up with the business, because there are just some major corporations that are like, you know what, we don't want our people using their iPhone. We want this professionally done and done perfectly. And you know what, I get it. So I can understand why this scales, along with the rest of the business, but overall, I wouldn't expect that to be super high margin. So, their subscription gross margin includes subscription and license, and that's the key focus. That's the 80% plus gross margin. Now there is some nitpicky aspects where you could say, hey, they're not including, like capitalized, software expenses here, and so maybe they're inflating it. But hey, let's just give them benefit of the doubt here and say 80% combined. Their gross margin is, 50% plus on the way to 80%, because they're getting more and more subscriptions over time. So over time, you're going to trend towards 70-80% gross margins, of which, if you're at a 70 to 80% gross margin business, then you probably are able to get scale, leverage your R&D, leverage your sales and marketing, and at some point, let's say, have 20 to 30% operating margins in, let's say, 5-10 years out. Like that's how I'd start thinking about that. But to be honest, they're not even projecting that. They're projecting 11% 10% operating margin within 5 years from now. And they're expecting pretty, material losses for the next few years, for at least the next 3 years. And then you'd really start breaking even, start making money in year 4 from now. So 2024. So that is sort of worth calling out. What is sort of weird about this projection, and I wonder if this was deliberate, the fact that they don't show the growth revenue figures means like, hey, maybe we don't want you to notice this. But it is weird to show growth rate. Like, first of all, if you're willing to create a line item for subscription gross margin versus regular gross margin, there's room for revenue growth rate that you can put here on a consolidated basis, at least in my opinion. So here it is. This is like 80, 90% growth in 2020. Then in 21, it's decelerating fairly significantly to 58%, but then it's 83% and then 81%. And that's generally not how businesses work. Where generally, if you have a really great growth rate, the law of large numbers, that it's really hard to keep growing at that rate, let alone accelerate to, from 58% to 83 and 81%. Now, it's also an aspect of like, well, wait a second. In 2020, you probably had some sort of COVID bump, I would suspect, that would help drive their growth, as all these real estate firms are like, hey, this might be a little harder for us to sell our wares or sell these properties or rent these properties. Let's do everything we can. Well, the next thing we can do is make sure we're subscribed and paying for this software, and so that way anyone in the world can easily check these out. And so I just wonder, how those dynamics play around with these growth rates. It definitely makes me a little bit skeptical. So when I look at these figures, I would say, hey, let's assume this management case is the high side when we're thinking about these figures, as we lay in our potential valuation work. So all in, by 2025, they're saying, hey, we think we could be doing $750 million in revenue, and we're generating around 10% profit margin. And so here it is. This is sort of my high level valuation sheet, and this is part of my value proposition to you, the loyal YouTube subscribers, where you can click on the link in the description of this video, where you click on it and you can play around with the assumptions, whether or not you think my growth rates are too low, or my margins or my valuations are too low. And I try to work from a logical framework to sort of say, hey, does this have an attractive risk reward? And oftentimes, most of the time, I pass. Most of the time I say, you know what, this doesn't cut it. I don't see 200% upside and 20% downside. Usually it's cases like this where it's like, hey, maybe I can make 70% and maybe I can lose 70%, but I don't find it crazy compelling. And that's just personally how I do it. I prefer that dramatic risk reward. When I look at this, and this is approximately $18 a share, it's been a little volatile today. At one point it was 17, and another point it was 19. So I picked $18 a share. Using the share count from the presentation, I rounded up a little bit. So just because in the presentation they didn't include warrants and options, and in my mind it's like, well, dude, you should. I mean, that's part of the dilution, and they just didn't have a footnote saying how much it was. So that gets to around $5.4 billion market cap. And this is the way you should be thinking about it in terms of valuation versus going to Yahoo Finance. And look, Yahoo Finance doesn't update it until after the deal goes through. This is before the deal, and this is how you need to be thinking about, which is the share price of the SPAC now multiplied by the pro forma share count to get what's the implied market cap of Matterport when you're thinking about the valuation. So 46 million revenue in 2019, guiding to 86 million in 2020, and that's what we're seeing here, 46 to 86. So that gets this 87% growth. So then do a range. They're projecting 123 million in revenue in 2021. So let's assume they actually beat that. Maybe they're being too conservative. So here it is, 120 million on the low side, 125 in base, 129 million on the high side. You can see this range of growth. What's the long-term operating margins? I already mentioned, hey, if long-term you're trending to 70 to 80% gross margin, you can probably get pass-through of at least 20 to 35%. Ballpark figure. This is back of the envelope calculation. Slap on some sort of tax rate, and what's that implied earnings multiple? The reason why I like using an implied earnings multiple based on optimized margins is because your return from today until then, that optimized margin is how you would be valued at maturity. That means your potential return between now and then is based on your revenue growth versus seeing some sort of hyper growth in earnings that's based on margins ultimately reaching what you think they are. So this is a way of saying, hey, this is what I think you could be valued at maturity, or this is how people will start thinking about you. And so the delta between now and then is driven off of revenue growth. So then what's the revenue growth rate? 30, I'm putting 30 to 55%, low to high. This 55% does capture largely management's call, because they're saying 747 by 2025, and I'm saying 744. I just put in 55%. Once again, this is a sheet. You click file download. You can play around with the assumptions yourself. So what's the end multiple for this business? I slap somewhere between 30 and 45 times. Honestly, that 45 times strikes me as pretty rich, because keep in mind this is 5 years out. Is it possible that it has that valuation? Sure, why not? But it does strike me as pretty rich, and this 55% CAGR strikes me as super rich. Is it possible? Maybe. But slapping on an aggressive assumption multiple and an aggressive growth rate only gets you about 70% upside over the next 5 years, versus I think a more conservative approach. And keep in mind, 30 times, one might argue, is still pretty aggressive, would suggest, down a similar amount. So I look at this, and unlike some prior picks, especially the ones that Unrivaled Investing Journey subs know about, is that this doesn't strike me as asymmetrical risk reward, where I'm penciling out at least 100, at least 200% upside, where I'm thinking, hey, does this have 100, 200% upside and, reasonable downside, where maybe I'm willing to add more if it does fall. This just doesn't cut it for me as I'm looking at this. I do like their value proposition. I do like that sort of setup, but there also are some other red flags in terms of their projections. I'll call out one of them here. For example, if you look at this bridge, and this is part of their bridge to sort of say, hey, look, hitting our 2021 revenue projections are going to be easy, because look, we start off with 2020 revenue, take where we were. They're sort of trying to do a bridge to say, hey, how do you get from 2020 to 2021? How likely is it that you get this 50-60% growth from year to year? And the answer is, hey, we are already at this rate, so let's say 96 million at December 2020. Then let's layer on, hey, we think we can win another 17 million in subscription business during the year. And then you also have an incremental 11 million in products and services. And that just strikes me as weird to project that, once again, when half the business is this more than half their revenue, or a large chunk of their revenue, not more than half, a large chunk of their revenue was tied to products and services, of which their products, 40% of their revenue was tied to product sales, which is one time in nature, selling that fancy camera in order to capture this 3D representation. So I look at this and I'm thinking, wow, it was rolled out in May of 2020, the iPhone for Matterport. After that, it was Android. And so to say like, hey, we're going to go even more, we're going to capture even more with products and services, that strikes me as aggressive. Like, this bridge makes sense to say, hey, this is our recurring revenue if it's a pure software business. But when 40% of your sales are one time in nature, doing this bridge is a little bit tricky. It's a little bit, I don't want to say dishonest. It makes you, I think it makes it look like it's a lot easier than it actually is. That's my main takeaway from this. There's some other concerns I have with the presentation, but that's, this video is already running along, 30 minutes. So I'm going to save that additional content for Unrivaled Investing Journey subs. And, as I look at this, my summary on Matterport is it seems like a special business. They're creating digital twin of billions of real estate value, and there's a lot of potential valuable secondary effects over time. Creates lots of opportunities, lots of services, whether or not it's insurance or monitoring or construction or sales within the real estate. So I see a lot of different potential opportunities. I like the idea of a third-party marketplace sort of taking this data and figuring out new ways of spinning it. And ultimately, people know. See, this is the challenge here, is that with investing, the price reacts to the quality of the business, and as the price reacts, your return might suffer. And so people know it's an interesting business. Heck, it's nearly double the deal value. So the valuation at this point just doesn't strike me as that compelling. I don't see the dramatic, asymmetric risk reward here. That's just in my opinion. Of course, could it go higher or lower? Of course. everything I try to do is based in logic, where I'm trying to, especially in business, I'm trying to run this from a logical perspective, where it's like, does this company have a reasonable, using a logical framework, have a reasonable, attractive risk reward? I'm not looking to play the speculative game where, hey, here's a SPAC that hasn't announced a deal yet, and now it trades at a 4x premium to that cash just based on rumors. I mean, that's just levels of speculation, and you should recognize you're playing a very speculative game. Whereas here, I'm thinking like, what's the fundamentals? What's the logic over time? And over a multi-year period, I believe fundamentals should prevail. And ultimately, at the end of the day, while I like Matterport in terms of their value proposition, I'm just not crazy about their valuation. I think I can find better risk reward setups, and I've called out several of them to Unrivaled Investing Journey subs. You can go to unrivaledinvesting.com, click on Journey, and there's a lot of different content there, a lot of exclusive content. And if you're interested in seeing exactly what I'm laying out, the full catalog of content is in the description here. So you click on that just to see all the exclusive posts, and you can click through if you're interested. The main goal with Journey is to identify potential multi-baggers. So each month I call out at least one potential multi-bagger. Additional perks is this educational videos, as well as you can see what my own personal portfolio looks like. What do I buy, sell, and hold, and a full download of everything. And at the end of the day, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com, click on Journey. Ultimately, Matterport's super interesting, but I think you can find better risk reward out there. That's my take for right now. And if you enjoyed watching this video on GHVI or Matterport, please make a point of subscribing. If you're already a subscriber, I appreciate that thumbs up, and thank you so much for watching.